morning, ladies and gentlemen. Welcome once more to the Financial Times headquarters in London for the latest instalment in the PWM Expert Series. Our subject today is investing in European equities. With me today to discuss this topic is Thierry Rojat from the Equities division of BNP Paribas Investment Partners in Paris. Thierry, you mentioned the ECB's package of measures announced by Mario Draghi at the beginning of June as a key determinant in the future performance of equity markets. But there's two ways to look at this. There's, we can look at this as a positive shot in the arm, or we can say, these lowering rates signalling asset purchases, that they show a deep concern about the Eurozone's economic weakness. How would you look at these measures? Ones that we should be concerned about, or ones which will have a very positive impact?
It's a fair point. It's always a question of the glass half full, half empty. I mean, the economy is not growing on a stellar pace. So, of course, there's reason for concern. And when you see the magnitude, the ambition of the last ECB decision, you can second guess that it's because the state of the economy is very poor. I think it's not that true, and I think it's just showing that the ECB is determined to get the thing fixed, and there's no time left. So it has to have an ambition plan. This was an ambition plan. There may be further going ahead, certainly not in the coming months, because the ECB declared that they won't do much from now on in the coming months, but at least this was an ambition plan. Especially considering that now the bank can again have access to cheap financing, but not put it back to the ECB because the remuneration will be negative. So what the ECB is trying to achieve is to make sure the credit mechanism, which is dysfunctioning, is reigniting again, is working again, because it's key for this economy. I mean, every economy needs credit. Europe is financed 80%, roughly speaking, by its banks. It's the other way around in the US, it's 20%. So on both sides of the Atlantic, the regulator since the crisis has been very tough, asking banks to have more and more equity in their balance sheet. And you can appreciate that if your economy depends at 80% from bank financing, if you proceed this way, you just kill your economy, because you prevent banks from lending to this economy. And it may be why as well the US has recovered more quickly, because in the US you can borrow and get money more easily through issuing corporate bonds. In Europe, it's not the case.
If I can just come in there,
yeah?
Thierry, will this reignition be a successful one for you? Will it result in a renewed upward trend, or do you believe that equities are perhaps too expensive and some say even displaying bloated valuations for the longer term?
I think it will have an impact, a serious impact. If a northern bank, which have maybe less problem in terms of financing, can manage to, instead of giving back the money to the ECB, they borrow from the LTRO and give it and lending to other southern European banks, this may reignite something which is not working properly. Securitization as well is something which is locked, which is almost something to resurrect. And by the way, the Bank of England is working with ECB to try to figure out the way to resurrect securitization. Yeah. This would be a great help for Europe. Now, it's true the European equity market is up for some time. The valuation is up, of course. It lasts almost since September 2011, so it is a long way. But the same applies to other markets. So Europe is not as such alone in this with this concern of valuation. Is it expensive? It's not anymore value. In absolute terms, difficult to judge, to appreciate if equity are expensive. I found interesting metrics to look at that, for instance, which is if you look at the index level, like for instance the MSCI Global Index, and you look at it versus, let's say, the global GDP in nominal term. and you do a ratio like a P ratio, and you look at what it has done for decades or so, and you realize that this multiple, this metric, is make you feel that the equity market in its globality is very cheap. Last time we had this level, this relatively depressed level of appreciation, of valuation, it was in the late 70s and beginning of the 80s. But the context was different. In the late 70s and beginning of the 80s, there was, a lot of inflation. Currently, it's certainly not the case. A lot of central bankers would dream to have to fight inflation, and they care about low inflation and deflation right now. So
that's a major risk for you, the deflation?
Deflation is not a risk. It's more low inflation. I don't think we'll see deflation. We see what is lasting on inflation or deflation is the way wages are growing or not growing. And wages in Europe are not going up massively, but they are not going down. But low inflation is definitely a headwind for European recovery. So in the current, deleveraged economy with low growth, inflation and lack of it is definitely a headwind. And hopefully what the ECB has done will help by making sure the credit is flowing again, will help this issue to be fixed at some point in time. But it will take quite a few quarters to see the impact on inflation.